Cash flow is a universal problem for small business. Sales and collection of receivables produce cash. However, excess funds typically purchase inventory, equipment, or other asset necessary to operate. Consequently, many businesses seek expert and external financing to meet their cash demands. When a firm raises the money for working the capital or capital expenditures by selling the bonds, bills or notes to the individuals or the institutional investors. In return for lending the money, the individual or institutions become creditors and receive a promise that the principal and interest on the debt will be repaid. A business can finance its operations either through equity or debt. Equity is cash paid into the business by investors. The business owner is usually one of the investors. Investor receive a share of the company, in effect a percentage of its proportional to the total investment paid in. The share of the stock may appreciate in the value in proportion to increase in the business net worth, or it may evaporate to nothing at all if the business fails. Investors put cash into company in the hope of stock appreciation and yield of dividends, which the business may pay to the investors. Dividends are a proportion of the net profits of the business. If the business does not realize a profit, it cannot be paid a dividend. The investors can get his or her investment back only by selling the share to someone else. In a privately held company, investors have less liquidity because the shares are not traded in the open market, and the purchaser may be difficult to find. This is one reason why successful and rapidly growing businesses are under pressure by the stockholders. This is one of the reasons why successful and rapidly growing small business are under pressure by stockholders to go public, and thus to create an easy way for the investors to cash out. Debt financing, by contrast, is a cash borrowed from the lender at a fixed rate of return and with a predetermined maturity date. The principal must be paid in full by the maturity date, but the periodic repayments of the principal may be a part of the loan arrangement. Debt may take the form of a loan or a sale of a bond. The form itself does not change the principle of the transaction. The lender retains a right to the money lent and may demand it back under the conditions specified in the borrowing arrangement.
After starting this module, we shall be able to learn the concept of measurement of cost of capital, know the difference between specific and overall cost of capital, analyze the tax advantage associated with cost of debt, evaluate the cost of debt, learn the issues involved in calculation of cost of debt, and solve the related practical illustrations. The measurement of cost of capital is the process of determining the cost of funds to the firm. The cost of capital is the company's cost of using funds provided by creditors and shareholders. It is the cost of its long-term sources of funds, that is debt, preferred equity, and common equity. The cost of each source reflects the risk of the assets the company invests in. A company that invests in assets having little risk in producing income will be able to bear lower costs of capital than a company that invests in assets having a higher risk of producing income. For a given company, debt is less risky than preferred stock, which in turn is less risky than common equity stock. Therefore, the preference shareholders require a greater return than creditors, and the common shareholders require a greater return than the preference shareholders.
For an investment to be worthwhile, the expected return on the capital must be greater than the cost of capital. The cost of capital is the rate of return that capital could be expected to earn in an alternative investment of equivalent risk. If a project is a similar risk to a company average business activities, it is reasonable to use the company's average cost of capital as the basis for evaluation. A company's securities typically include both debt and equity. One must therefore calculate both the cost of debt and the cost of equity to determine a company's cost of capital. However, a rate of return larger than the cost of capital is usually required. The cost of debt is relatively simple to calculate and it is composed of the rate of interest paid. In practice, the interest rate paid by the company can be modeled as the risk-free rate plus a risk component which itself incorporates a probability rate of default. For the companies with a similar risk or the credit ratings, the interest rate is largely exogenous, that is not linked to the cost of debt. Once the cost of debt and the cost of equity have been determined, their blend, the weighted average cost of capital, can be calculated. This weighted average cost of capital can be used as a discount rate for a projected cash flows. When the companies borrow the funds from the outside or take a debt from the financial institution or other resources, the interest paid on that amount is called as cost of debt. The cost of debt is computed by taking the rate on the risk-free bond whose duration matches the term structure of the corporate debt, then adding a default premium. This default premium will rise as the amount of debt increases. Since all other things being equal, the risk rises as the amount of debt rises. Since in most of the cases, debt expense is a deductible expense, the cost of debt is computed as the after-tax cost to make it comparable with the cost of equity. Earnings are taxed as well.
Specific cost is the cost of individual sources of finance. All the long-term sources of finance like debt, preferred equity, common equity, and even retained earnings have the specific cost attached to them. In order to calculate the overall cost of capital of the firm, we combine all these costs and calculate the firm's overall cost of capital depending upon the weightage the each source of finance has in the firm's overall capital structure. The firm can calculate the overall cost of capital for different alternative capital structures and choose the one that minimizes the cost. The cost of debt refers to the cost associated with using fixed interest bearing securities like debentures, long term loans, and bonds in the firm's capital structure. The rate of interest paid by the firm is comprised of risk free rate, that is, the compensation for time value of money, and the risk premium, which depends upon the default risk. The higher the default risk associated with the firm, the greater the rate of interest it has to offer to raise the funds. It should be noted that the rate of return demanded by the lenders of capital is not the same as coupon rate offered on debentures. It is a common mistake done by a lot of people while calculating the cost of debt. The correct cost of debt capital is the yield to maturity of the firm's debt. The reason behind it is that the price of debt fluctuates in the market to reflect the changes in both overall credit environment and the risk specifically associated with the firm.
The cost of debt refers to the cost associated with using the fixed interest bearing securities like debentures, long-term loans, and the bonds in the capital structure. In other words, it is the rate of return demanded by the lender who loan money to the company. The cost of debt is a relative simple to calculate and it is composed of the rate of return paid to the debt providers. The rate of interest paid by the firm is comprised of risk-free rate, that is the compensation for the time value of money, and the risk premium, which depends upon the default risk. The higher the default risk associated with a firm, the greater the rate of return. it has to offer and to raise the funds. The credit rating agencies provide a credit rating to the firm which are an indicator of the firm's default risk. Higher credit rating firms are able to raise the debt at a lower interest rate as comparable to the firms having the lower credit ratings. Further, the interest payable on the debt capital is the tax deductible expense, that is, the firm gets the extra tax advantage on paying the interest expenses. Therefore, the firm calculates the after tax cost of capital. It should be noted that the rate of return demanded by the lenders of the capital is not the same as the coupon rate offered on the debentures. We can estimate the market required rate of return by examining the yield to maturity on the firm's debt. It is a common mistake done by a lot of people while calculating the cost of debt that they consider the coupon rate of interest as the cost of debt. But this is not correct. The correct cost of debt is the yield to maturity of the firm's debt and not the coupon rate on its existing debt. Yield to maturity is the rate current purchasers of the debt would earn if they held the debt to maturity and receive all the payments as promised. It is yield that the investors demand on the firm's debt, new or existing. The reason behind is that the price of the debt fluctuates in the market to reflect the changes in both overall credit environment and the risk specifically associated with the firm. The company's cost of capital is a forward-looking and based on the current conditions, while the coupon rate on the existing debt is historical and set under the potential very different conditions.
In the case of debt, the return paid to the debt holders is not the same as the cost to the firm. This is because the interest paid on debt is a tax deductible expense. When a firm uses debt financing, the cost of interest paid by its offset to some extent by the tax savings. The net cost of debt is actually the yield offered less the tax savings resulting from tax deductible interest payment. Thus, the actual cost of debt is less than the yield to maturity and can be expressed as shown. Amongst all the available sources of finance, debt is the cheapest source of finance. It is the safest form of investment from the point of view of creditors because they are the first to be paid regardless of whether the firm has profits or not. Further, they are the first claimants on the company's asset at the time of its liquidation. Also, the important reason for having debt having the lowest cost is because of the tax deductibility of interest payments. Now, we shall see the calculation of cost of irredeemable or perpetual debt. The cost of perpetual or irredeemable debt is calculated using the formula as shown, where KD equals after tax cost of debt, I equals annual interest payment, B naught equals issue price net of any discount, flotation cost, and so on, T equals tax rate. For instance, A Limited issued 12% perpetual debentures of rupees 100 each at a discount of 5%. The tax rate applicable to the company is 40%. We can calculate the cost of debt using the formula as shown, such that the value of the cost of debt comes out to be 7.578%. For calculating the cost of redeemable debt, the issue price is equated with a series of cash outflows associated with the payment of fixed interest charges and the repayment of principal amount, such that the formula for the same can be expressed as where B naught equals issue price, I equals annual interest payments, KD equals after tax cost of debt, PN equals redemption value, T equals tax rate, and N equals life of debentures. There is also a shortcut method for calculating the cost of capital, whereby the formula for calculating the cost of debt is where RV equals redemption value. Let us consider an example. A Limited issued 15% debentures of Rs 1000 each at a discount of 5%. Flotation cost is also 5%. The debentures are to be redeemed after 10 years. Tax rate applicable to the company is 50%. The issue price will be Rs 1000 less discount and the flotation cost, that is Rs 1000 minus 50 minus 50, that is Rs 900. We can calculate the cost of debt using the formula and substituting the values as shown here. Solving the equation by trial and error, we get the cost of debt as 9% approximately. We can also solve the above example by substituting the values in the shortcut formula as shown here, such that the cost of debt comes out to be 0.0894737 or 8.94%. If the redemption is done in installments, the equation will be as shown here, where the numerator represents the annual outflow on account of interest payment and repayment of principal. Let us understand this with the help of an example. A Limited issued Rs 1 lakh, 15% debentures of face value Rs 100 each at a discount of 5% and flotation cost of 5%. They are to be redeemed in 5 equal annual installments of Rs 20,000 each starting at the end of the first year. Tax rate is 50%. Let us calculate the cost of debt for A Limited. Net proceeds can be worked out to be Rs 90,000 after subtracting the discount of Rs 5,000 and the flotation cost of Rs 5,000. Thereafter, we shall find out after-tax interest payment and principal repayment for each year end to calculate the total outflows. After-tax interest payments can be calculated using the formula interest in brackets 1 minus tax rate. In our case, by multiplying the interest at each year end by 1 minus 0.5, that is by 0.5. The total outflow for each year can be worked out in the tabular form as shown. Putting these values in the formula we get such that by trial and error method, the cost of capital comes out to be 12% approximately. Let us understand this with the help of an example. A Limited issued Rs 1 lakh. While calculating the cost of debt, there are certain issues that are to be taken care of. These are: it is not easy to find out the market price of those bonds or debentures which do not trade in the secondary market. Because of this, it is a standard practice to estimate the cost of debt using the average yield to maturity on a portfolio of bonds with similar credit rating and maturity as the firm's outstanding debt. The cost of floating rate debt is difficult because the cost depends not only on current rates but also on future rates. Calculating the cost of debt having option-like features like callability, putability, convertibility, etc. is also a little cumbersome. Non-rated debt makes it difficult to determine the yield on a similar yielding debt if the company's debt is not traded.
Debt is borrowing the money from an outside source with a promise to return the principal in addition to an agreed upon level of the interest. Although the term tends to have a negative connotation, startup companies often turn to debt to finance their operations. In fact, even the healthiest of the corporate balance sheets will include some of the debt. In finance, debt is also referred to as leverage. The most popular source of debt financing is the bank, but the debt can also be issued by the private companies or even a friend or a family member. Let us now discuss the advantages of debt financing. Maintain ownership. When you borrow the money from the bank or another lender, you are obliged to make an agreed upon the payments on the time. But that is the end of your obligation to the lender. You can choose to run your business however you choose without an outside interference. Tax deductions. This is a huge attraction of the debt financing. In most of the cases, the principal and the interest payment on the business loan are classified as business expenses and thus can be deducted from your business interest taxes. It helps to think of the government as a partner in your business with a 30% ownership stake or whatever your business tax rate is. If you can cut the government out of the equation, then it is beneficial to your business. Lower interest rates. Furthermore, you should analyze the impact of tax deduction on the bank interest rates. If the bank is charging you 10% for your loan, the government taxes you 30%, then this is an advantage. Take a loan, you at a 30%, and then it is advantage to take a loan you can deduct. For example, take 10% and multiply it by 1 minus the tax rate. It is in case 10% times 1 to 30%, which equals the 7%. After our tax calculations, we will be paying the equivalence of a 7% interest rates. However, debt financing isn't free from drawbacks. The drawbacks of the debt financing are repayment. As mentioned above, your sole obligation of the lender is to make your payments. Unfortunately, even if your business fails, you will still have to make these payments. And if you're forced into bankruptcy, your lenders will have a claim to repayment before any equity investors. High rates. Even after calculating the discounted interest rate from your tax deductions, as explained above, you may still be faced with a higher interest rates. Interest rates will vary with the macroeconomic conditions, your history with the banks, your business credit rating and the personal credit history. Impacts your credit rating. It might seem attractive to keep bringing on the debt when the firm needs the money. A practice knowing a levering up, but each loan will be noted on your credit rating. And by more you borrow, the higher the risk to the lender and the higher interest rate you will pay. Cash and collateral. Even if you plan to use the loan to invest in an important asset, you will need to make sure that the business will be generating sufficient cash flows by the time the loan repayment starts. And also, you are likely to be asked to put up the collateral on the loan in case you default on your payments. The alternatives to the debt financing. Equity financing. This involves the selling shares of your company to the interested investors or putting your money into the company. Mezzanine financing. The lenders who set on this debt tool offer the business unsecured debt, that is, no collateral is required. The trade-off is a high interest rate in the 20-30 range. Plus there's a catch. The lender has the right to convert the debt into equity in the company if the company defaults on the payments. Despite the high interest rates, the mezzanine financing appeals to the entrepreneurs because it offers the quick liquidity. And even though it can be converted to equity, the issuing bank usually does not want to be an equity holder, meaning they are not looking to the control of the company. Hybrid financing. Most likely you are turned on the combination of debt and equity to fund your venture. The question then becomes, what is the proper combination? When deciding the optimal capital structure, a common finance theory is the Modigliani-Miller theorem, which states that a perfect market without taxes, the value of the firm is the same whether it is financed completely by the debt or equity or a hybrid. This, however, is considered too theoretical since the real companies do not have the access to taxes and therefore are the costs associated with bankruptcy. There are several other theories and the formulas on determining the optimal capital structures.
Let us now summarize what we have learned in this module. In this module, we have learned about the specific cost and the overall cost of capital, and specifically the cost of debt. We have also learned how to calculate the cost of different types of debt and the various issues related to the calculation of debt.
Recapitalizing what we have learned in this module, we can say that the measurement of the cost of capital is the process of determining the cost of fund to the firm. All the long-term sources of finance like debt, preferred equity, common equity, and even the retained earnings have their specific cost attached to them. In order to calculate the overall cost of capital of the firm, we combine all these costs and calculate the firm's overall cost of capital. The cost of debt refers to the cost associated with using the fixed interest bearing securities like debentures, long-term loans, and the bonds in the firm's capital structure. The net cost of debt is actually the yield offered less the tax saving resulting from the tax deductible interest payments. Thus, the actual cost of debt is equal less than the yield to maturity. After tax, cost of debt is equal to yield multiplied by brackets open 1 minus the tax rate brackets closed. Debt is the cheapest source of finance. There is difference in the calculations of cost of irredeemable and redeemable debt. There are some issues involved in the calculations of cost of debt. For example, it is not easy to find out the market price of these bonds or debentures which do not trade in the secondary market. The cost of floating rate debt is difficult because the cost depends not only on the current rates but also on the future rates, and the calculating the cost of debt having the option like features like callability, putability, convertibility, etc. is also a little cumbersome.